The publisher of this book, 100 Baggers, Stocks That Return 100 to 1 and How to Find Them, spent $50,000 just on the data to do the exhaustive study of finding every single stock that you could have bought between 1962 and 2014 that would have 100x'd your money. And in this video, I'm gonna show you the #1 secret that you must know in order to use the stock market to not just double your money, not 10x your money, but 100x your money. Buying a 100x stock, also known as a 100 bagger, would mean turning $1,000 into $100,000. Or it would mean turning $10,000 into $1 million. So early in the book, the author shows us this chart, which shows annual returns and how many years it'll take to 100x your money at that rate. And as you can see, if you can compound your money at 14% annually, then it will take you 35 years to 100x your money. And if you can compound your money at 36% annually, it will take only 15 years. The book's research found that there were 365 stocks that you could have bought between 1962 and 2014 that would have multiplied your money 100x. Now, of course, it didn't happen overnight. Even for the ones that took the shortest period of time, it still took 5 years for it to happen. And here's the table that shows the stocks that did it the fastest. Pretty impressive, right? Can you imagine turning $10,000 into $1 million in 5 years? Or even just 10 years? And from simply making one purchase and holding on? This chart here now shows us that for the majority of the 365 100 bagger stocks, it took between 16 and 30 years to reach 100 bagger status. But now check this out. This graph right here is showing us the average holding period of stocks over the years. And it's showing us that as of lately, stocks are being held on average for only about 6 months before they're sold and replaced with some other stock. This goes for individual retail investors like you and I and money managers alike. 6 months on average. And by the way, I should say that this massively contributes to why stocks can become mispriced, which of course is what us investors seek to take advantage of. Ben Graham, Warren Buffett's teacher, and the person some refer to as the godfather of value investing, once wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." And to help combat this problem, in the 100 Baggers book, the author dedicates an entire chapter to something called the coffee can portfolio strategy. And he spends so much time on it in the book because he considers knowing this little piece of knowledge to be one of the most important factors to achieving 100 bagger results. The coffee can portfolio gets its name because the idea behind it is to simply buy shares of the very best companies, the ones you'd be willing to hold for 10 years, actually get the physical stock certificate in your hand, and then fill your empty coffee cans with them, stash the coffee can away for 10 years, and then only after the 10 years have passed, then you can go ahead and look at how your stocks have done. So what's the point of this? Why would you do this? Well, the point is literally to protect you from yourself. The author points out that Apple, for example, from its IPO in 1980 through to 2012, was a 225 bagger, and says this: "But those who held on had to suffer through a peak to trough loss of 80%. Twice. The big move from 2008 came after a 60% drawdown, and there were several 40% drops." And what's more is that many of the 100 bagger stocks that they found had a very similar history of huge price swings that would have scared even some of the most level-headed people into selling off their shares way too soon. Now, panic selling because the market price dropped is actually only half of the story. Selling your winners too soon is the other half. In Warren Buffett's 1995 letter to shareholders, he reminisces about the first time he discovered and bought Disney stock. He wrote, "I first became interested in Disney stock in 1966, when its market valuation was less than $90 million, even though the company had earned around $21 million pre-tax in 1965 and was sitting with more cash than debt. At Disneyland, the $17 million Pirates of the Caribbean ride would soon open. Imagine my excitement, a company selling at only 5 times rides. Duly impressed, Buffett Partnerships Limited bought a significant amount of Disney stock at a split adjusted price of 31 cents per share. That decision may appear to be brilliant given that the stock now sells for $66, but your chairman was up to the task of nullifying it. In 1967, I sold out at 48 cents per share." Now, Buffett wrote that in 1995 as part of a lesson to the shareholders reading it, but Disney stock has actually split twice more since then. So this means if we include the additional stock splits that happened after he wrote that, then the stock split adjusted price for when he originally purchased that Disney stock back in 1966 was was actually just slightly over 10 cents per share. And Disney stock today is trading at $173 per share. From 10 cents to $173 per share is massive, but that's not even considering dividends. Once you consider dividends into that picture, it looks even nicer. Now, Disney actually has suspended their dividend just very recently so that they could maintain a strong financial position as they got through 2020. But prior to that, in 2019 alone, they paid out $1.76 per share in dividends. That would be like getting 17 times your original purchase price through dividends in one single year. All right, so buying and then not even looking at your stocks again for another 10 years is definitely not the full extent of the wisdom that comes from this incredible book by any means. And the book doesn't even necessarily suggest that that's actually what you should be doing either. But it does suggest that if you don't have the right temperament, then there's a really high chance that this coffee can approach will give you better results than whatever else you'll end up doing instead. In this chapter on the coffee can portfolio, he demonstrates the power of it by sharing a bunch of amazing stories and examples, including an extreme example of a fund called the Voya Fund, which was established in 1935. At the time of its inception, the fund purchased equal amounts in 30 stocks before proceeding to do absolutely nothing for the next 80 years, never selling anything and not buying anything new either. And would you believe that this untouched fund has actually beaten the S&P 500 for the past 40 years? And the cool thing about this fund, by the way, is that while, yeah, the fund still owns some of the original companies from the initial purchases back in 1935, today, because of various mergers and spin-offs, the fund actually owns a bunch of new names as well. As I've been studying different successful investors over the years, I've come to the realization that the most successful investors are very reluctant to sell their stocks. And the conclusion that I've come to for how to manage my own money is to, 1, only buy the stock of a company if I'd be happy to own it for at least 10 years. 2, intend to hold on to it forever. 3, only sell if there's been a significant change in the business's fundamentals and never just simply because the market price has risen above intrinsic value.